Tensions in the Middle East have flared again. The U.S. has resumed airstrikes on Iran. The trigger was a series of attacks on oil tankers. In the Strait of Hormuz, Washington says it is responding to protect shipping lanes. But the move also ends a short-lived truce. The Treasury has revoked temporary waivers that allowed Iranian crude sales. Sanctions are back in full force. Oil markets reacted immediately. Prices jumped on supply fears and geopolitical risk. That adds a new layer of inflation pressure. Just as rate debate heats up, in U.S. equities, the mood shifted. Tech names and semiconductors took a hit. Even Samsung's record earnings were not enough to lift. The chip complex. Investor expectations had simply been too high. Money flowed out of AI leaders and into laggards. This is classic sector rotation. When one group gets too expensive, funds hunt for value elsewhere. The S&P 500 held up because many non-tech stocks actually rose. But the narrative is changing from pure AI capex excitement to a more balanced view of risk and reward. Geopolitics is now part of that equation. Higher oil prices can feed into sticky inflation. That keeps the Fed on guard. All eyes are on the FOMC minutes. This is the first read on policy under Chair Kevin Warsh. Investors will search for clues on the rate path. Trump's NATO stopover added another layer. He expressed frustration with European allies over Iran, but praised Turkey and hinted at F-35 sales. That signals a transactional approach to alliances. Markets are watching closely. For now, the message is clear. Tech is not dead, but it is no longer the only game in town. Oil, defense, and industrial names are back in focus. Rotation is the theme, and geopolitics is the wild card.